Hi, I'm Amy Ford, and in this video, I'm going to walk you through the accounting process, also called the accounting cycle. We'll go through each step together, which includes basic transaction analysis, adjusting entries, and closing. Here's our accounting cycle. We're going to go through each of these steps together. We'll refer back to this graphic at each step along the way. I like to think of it as like the "You Are Here" stamp on the map at the mall. Our first step in the accounting cycle is to analyze the transaction. Each transaction we record in the accounting process has a dual effect to the accounting equation. Remember, this is the equation that must always remain in balance. So before we jump into debit this and credit this, I like to make sure that my students understand the effect on the accounting equation. If we do this first, I think it makes the debit-credit stuff much easier. Let's start at the beginning with typically the first transaction to start a company. Now, I'm numbering our transactions so we can refer back to them later when we work on the next step. So, number 1 says issue $50,000 of stock for cash. What's the impact on the basic accounting equation? We receive $50,000 cash, so the assets, specifically the asset cash, will increase by $50,000. The company's stockholders' equity, specifically the account common stock, will also increase $50,000. After this transaction, the accounting equation is in balance. Now, we need a place to do business, so we buy a building. On January 1st, we purchase a building for $100,000. We borrow the entire amount from the bank, signing a 6% 10-year loan. Interest is going to be due on the 15th of the following month. This means our first interest payment will be due on February 15th. Okay, right now on January 1st, we don't need to worry about the interest. Let's focus on the transaction of purchasing the building. We got a new asset, building. So we show an increase to the assets of $100,000. This transaction also increases our liabilities, as we now owe $100,000 to the bank. We will record this amount in notes payable. Now, so far, both of our transactions have shown increases to both sides of the equation. That is not necessarily the case for all transactions, so let's move on to some more examples. In number 3, on January 1st, we purchased $10,000 of equipment with cash. This transaction will only affect or impact the left side, the asset side of the basic accounting equation. We increase the asset equipment and decrease the asset cash. Notice how the net effect is 0 on the left side and 0 on the right side. So the accounting equation is still in balance. Now, this is one that my students often find the most confusing. Just remember to ask yourself, what is increasing, or what is the business getting? What is the impact? Is this going up or down? Ask yourself these questions, then fill in your answers. Now, once you think you have it, make sure you still have a balanced equation. In number 4, we purchase office supplies. Think of like paper, ink toner, file folders, those sorts of things. We have a local supplier who lets us put these purchases on account. Now, this means we do not have to pay for the supplies at the time we purchase them, so there's no cash in this transaction. We get supplies, which are assets right now, ready to be used in the business. We also now owe for these supplies, which increases our liabilities. We show a $1,000 increase to assets, specifically to the account supplies. The amount we owe our suppliers is called accounts payable, and we use that account to show the increase to liabilities. Number 5, on January 6th, we pay $200 rent for the month of January for office equipment. What did we pay with? Cash, of course. But notice how the transaction doesn't say cash this time. This is where accounting students must practice to become familiar with the seemingly endless ways to describe a transaction. Since we paid cash, the asset cash will decrease $200. The rent that we paid was for this month of January, and we say this is an expense of doing business this month of January. Expenses decrease retained earnings, which means expenses decrease stockholders' equity. In this balanced transaction, both sides of the accounting equation are decreased. Is what we've covered so far helping? I really hope so. If you want to learn more about recording transactions, including the debit and credit rules and how to prepare journal entries and adjustments, then click the link below or go to Gleim.com and look for our free basic accounting course in the CPA free resources section. In the course, you'll find great information on other topics such as financial statements and specific areas like inventory and accounts receivable, which may be helpful. So click below or go to Gleim.com to learn more.